Siemens is not a small company. It's got $110 billion in global revenue. It's also got $20 billion here in the U.S. So Joe, I wanted to start, since you guys cover most areas of the global economy, what is your view of the current state of the economy, and do you have any kind of sense of a macro forecast of what you think's going to happen in the next 12 to 24 months?
Well, I mean, obviously I also need to look into the crystal ball, as many other economists need to do, but the other thing we have is that we've got our customers who we can go to and ask them how they see the world and what their end markets look like. And I have to say, you know, the global economy is not one single thing which you at some point in time subtotal into 3 or 3.5% global GDP. It is about emerging countries, emerging economies which grow between 8 and 15%. It is about more saturated developed economies which grow between 0 and maybe 3%. So it is a really divided world at this point in time, and depending on where you're at and where you have your footprint, you may as do well or maybe not so well based on what your regional footprint is. So all in all, I believe that the emerging markets will plow full steam ahead. Yeah, at least. I mean, even if China comes down from 11, 12 to 8 to 9, I mean, this is still massive. So therefore, I think I wouldn't be too concerned about a big slowdown in the emerging markets, because on one hand, China and India are still very, very active, because they need to develop their infrastructure, and they have rightfully understood that this is necessary for sustainable growth. Right. And secondly, emerging countries is much more than China and India. If you look at the so-called second-tier economies, emerging economies, which we in our company call the CHIVETs. And CHIVETs stands for Colombia, Indonesia, Venezuela, Egypt, Turkey, and South Africa. Right. You know, they are also a massive, powerful economic circle, which offers us a lot of opportunity to grow. Now,
in the U.S., the Fed has decided to change nothing. They're kind of a less bullish forecast. Is it still 1 to 2% from your perspective in the industries you're in the U.S., or have you changed your forecast at all?
Well, I mean, first of all, I believe it was not really unexpected that there wouldn't be major changes, and there is, at this point in time, there is actually no way to go anyway, and if you don't know where to go, you better keep it as it is. Okay. So therefore, I believe that was expected, and I believe also well appreciated. I mean, in the United States, this is still the most powerful economy in the world. And this is something we must never forget. It's about 23, 24% of the global GDP, so there is massive economic power. The issue we are seeing here, of course, is, you know, there's unemployment, there is a divide between highly skilled labor and not so skilled labor. We have excess demand on high skilled laborers. We have about 3,000 jobs open in the United States.
Wow, Siemens.
Yeah, yes. Then we have another 1,000 coming online in North Carolina, where you're just building a factory. So therefore, we actually are lacking skilled workforce here, and we'd be happy to have more. So those people are really good, they are productive, they are dedicated to work. So there is a lot of opportunity.
You're the keeper of the cash, I guess, at Siemens, or at least
among other things.
Yes, among other things, and there's a lot of it. My latest figures I got off the Bloomberg were 19 billion U.S. versus 72 billion in long-term assets. That's a lot of short-term cash sitting around. And then you, of course, have the Osram public offering, which is rumored to raise another 3 billion. What are you going to do with all that money?
Well, I mean, first of all, it's not a problem to have cash. It is a problem not to have cash, and you are in trouble if you need and you don't have it. So therefore, I believe we need to have a very diligent approach to that topic. That cash has been earned over a very decent performance of the company. We're investing a lot of that now into organic growth. The ones who are following us closer in terms of analyzing the quarterly development of our P&L, they see that we invest heavily into innovation, R&D, into regional footprint, and also into regional engineering in those emerging economies.
Can you give me a sense of the magnitude of the investment cash being poured back into the business? Is it billions?
Yeah, we said we're going to invest about $2 billion more OPEX into sales, marketing, and engineering and R&D as compared to last year, which is a higher growth than we expect revenues to grow. So we clearly focus on organic growth versus buying into highly priced assets.
Now, I thought the story was that you were going to be aggressive on acquisitions in the U.S. Is that the case? Are you looking for things to buy?
Well, I mean, look, if acquisitions should serve as a purpose to get rid of cash, that would be the wrong direction. And you can be rest assured that I'm not willing, to let that one even come into play. I mean, in terms of M&A, obviously Siemens has not been as active as some others in the space. That's very true. On the other hand, if you look into our current, services and value spectrum, we go from oil and gas, which is energy exploration, deep sea, through energy generation, like wind power plants, like gas turbines, through transmissions, to distribution, to energy efficient use, into factory automation, process automation, building technologies, mobility. So if you look at that whole string, while we may as well not be as great in any given division, we have everything. So there is no white spot in the whole energy generation, distribution, and consumption agenda.
But your rival General Electric is constantly adding even small acquisitions in those areas, sometimes big billion-dollar purchases.
Well, I mean, they need to know what they're doing because they are responsible to their shareholders. We are responsible to our shareholders, and we've made several acquisitions, also bolt-on acquisitions in the past. And for example, the big wind acquisitions, which was 300 million in 2005. Now the revenues are up to 5 billion, and if I talk billion, I mean euro. So we have made some very, very favorable acquisitions. We also did some which didn't turn out to be that great. So clearly the focus now is organic growth. We invest into regional footprint, into technology and innovation. We will do bolt-on acquisitions, and if we talk about bolt-on acquisition in our size, we basically mean that could also be a smaller 4-digit million size, which is 1, 2, 3 billion. That's always something which is in the ordinary course of business. But we do not have a strategic necessity to buy into something because we are lacking that. Okay.
Dividend policy, any changes there?
Well, we just announced a change in dividend policy last year. We said we're going to return at least 30 to 50% of our annual earnings to our shareholders. We increased our dividend from 160 euro to 270, which was quite a...
It's running about over 2% now,
noticeable move. It's almost 3%. And 3% is just about, a notch above the 10-year bond. So therefore, and then, it's inflation correlated. So we actually feel good about dividend yield, and we continue to understand and to realize and to appreciate that our shareholders own the company. So there's got to be a balanced approach to growth, to building the business, and also, of course, make sure the shareholders get a fair return.
And there's been a broad restructuring of Siemens, changing of how divisions are divided up. I imagine massive cost cutting. Can you tell me a little, give me a sense of the magnitude of that, how that's impacted the numbers you're seeing as Chief Financial Officer?
It actually has been a massive magnitude of change in the company. If you only go back in 2005, it's not that far in the company's prospects of history, over 160 years. In 2005, 45% of our revenues have been outside the three sectors: energy management and automation, infrastructure, and healthcare. 45%. Today, we have only 1% of our revenues outside those three sectors.
So the company's highly concentrated.
That means we basically changed 45% of our revenues within less than 5 years. And we are not exactly a startup. So those are real meaningful numbers of businesses. That's been a massive change. And so that was a structural topic which was started 2005 and into late 2008. But what really changed that company, I believe, fundamentally to the better, was actually the fallout of a homemade crisis, which was our compliance crisis, which the company struggled between 2007 and 8. We brought that behind us, but that compliance crisis, gave that fundamental push and change in culture to make this company a much more focused company under the leadership of our new CEO, Peter Löscher. And this is something now which we need to build on. So we basically, if I may say, we really killed the dragon in the last 5 years, and now it is up to make this company conquer the princess. Go out, understand what are the needs, not just in emerging economies, but also in developed economies. Economies which are powerful but don't grow. In economies where you cannot sell more to your customers because they don't need it. But you have customers, for example, municipalities, cities, infrastructure, urban centers, which has an ever-growing demand because they've got ever more people. However, they can't afford that growing demand to finance. So you've got to come up with a solution which goes up and down the value chain of infrastructure, build that out, and help them basically reduce the cost per capita on what they have to do. And that's why we just recently, a couple of months ago, announced our fourth sector, and that sector is called Cities and Infrastructure. And that sector is exactly targeted to find solutions to customers who have big demand on serving the society, their citizens, and the infrastructure at less cost per capita.
And I assume that's where a lot of your R&D and engineering dollars are going to develop these new lines of products that
they go into this one. They go
Yeah.
into this one, combining bits and pieces of products to solutions which help the customer save money. And secondly, they go, of course, into deepening the regional footprint in the GVETs, in the BRICS. And that is more than just, sell more of the same. It is something about local design, local demand, because sometimes those products and solutions look different in emerging countries than they are in the United States or in Germany.
And has your cost structure changed at all in the last 5 years, and with an impact on your earnings and your EBITDA margins?
Well, obviously it has fundamentally changed. If we go, through the whole cost structure, you see that we fundamentally, shifted our resource capabilities towards emerging markets. In the area of the legacy, if you want to, we brought down the cost significantly by focusing much on engineering all across the globe. So we are an engineering company. We hire a lot of people, engineers, and we've got faster and more flexible.